taking a time to join this session. I hope you had a blissful weekend. So, without wasting time, today I want to talk about building generational wealth using life cover or life insurance. I was sharing on another platform yesterday. I've opened my note by saying this to the audience that we need to be the last generation to have our stories that start with a sad introduction. Because when you look at us as black people, most of us, when we have to share our stories, we have to start by this sad introduction of where we're coming from, how we're raised, how we went through life, and all the struggles. We may embrace struggles, but there is no glory in struggle. Some of those things, they are the same things that are affecting us to cope psychologically and to interact with other people. So we must be that generation that says we are the last generation to have sad stories. We are the last generation to stand there and share about the broken past, the struggles that we have to suffer in order for us to get somewhere. So, but it's not about just saying it and say we are the last generation. It's all about us making the right decision and buying the future. Hence, today's topic is going to challenge all of us to build a startup to be the advantage which our children are going to need. So, because I've noticed that most of us as black people, we consume a lot of funeral covers. So let me start by highlighting few things because I know all of us who are here we have funeral covers. So there are a few things that I want to highlight for you concerning funeral covers. Then after that, I will skip to my main subject, which is the main subject is using life cover to build wealth. So but I have to highlight this as far as all of us who are here. I'm 100% sure that all of us who are here, we have what is so called, we have funeral covers. So there are a few things which we have to highlight concerning those funeral covers. Then after that, I will skip to my main subject, which is life covers. So when it comes to funeral covers, I have these two things that you need to mark them and you need to follow through them as far as you're using the funeral cover. So the first thing that you need to understand about funeral covers, that funeral covers are subjected to a minimum and maximum limit. So according to the South African law, each and every individual is subjected to a limit of 100,000. Meaning, if you have a funeral cover should not exceed 100,000. So, if you exceed 100,000, it means you're going to have what is so called you are over insured. And then this thing happens especially in black families because we have siblings. Sometimes we don't communicate as siblings. Maybe let's say we're having a funeral cover for our parents. I have a funeral cover, my brother a funeral cover, my sister a funeral cover. All of us we are subjecting to one thing and not knowing that this thing is also regulated. And the reason why they put a maximum of 100,000, they say basically the aim of a funeral cover is to cover the cost of the funerals. It's not something that you can use to build wealth. In other words, if you wanna build wealth, you cannot use a funeral cover. Funeral cover is just for covering the cost of the funeral. So hence they project it in the maximum of 100,000. So let's say you have three different funeral covers with different institutions or different insurers. It also be determined by who is also the underwriter. I'm going to explain on that because it will be my second point. So if you have three and all of them they are paying 50,000 each, it means you're already over insured. And then the issue is this: when they discover, in fact, the hardest part about these guys is that you have sales reppers. Sales reppers, their aim is to make sure that they close the sales. So when they make sure that they close sales, they won't tell you that no, bro, you're over insured because they want to close a sale. Remember, it's their duty to close the sale. So they'll let you go and join that thing, but knowing that you're already over insured. So let's say now you are having these three funeral covers, different, it can be different institutions, it's okay. And then all of them, they say they're going to pay you 50, 50, 50. You are now over insured because the limit must always be 100,000. You are now sitting on 150,000. So upon death, these policies or this insurance will check out, then they can pay even less than, because you're already over insured. So when they assess everything and discover that you're over insured, they can also penalize you and pay you less. Or let's say, for instance, it's not you alone. You have your other sibling with 50,000. You have me with 50,000, and then you have the other one with 50. All of us, we said, we have joined for a mother for 50,000. All of us are expecting to get 50,000. There is a possibility that one of us or two of us might not get that money because we are already over insured. So the issue is that we are not being taught that everything that has been done in our country or other countries, as far as I know, those things are regulated. They're regulated. So these guys have to follow through those regulations. So because we just want to join, and sometimes because we might have some conflicts as a family, discover that I don't talk with my brother, or I don't talk with my sister, and to share that, no, I've also, or I've decided to open a funeral cover for my mother, and then so, okay, if you've opened it, it's fine. I cannot go further and open it because you've already opened it. Okay, now I'll focus on other things. We don't do that. Sometimes we keep quiet, sometimes we keep it as a secret, but the main thing is that at the end of the day, one might even suffer. And then the other thing concerning these funeral covers, also life insurances, there is this link I forgot, but I'll have to search it. I know someone who have this link. Sometimes your relative can have your particulars or your details, and they decide to join, if can be a funeral cover, whatever it might be, without your consent. So when they join for you, when you might be saying to yourself, "No, I'm not having any other insurance. I know that or I know my mother does not have any insurance," but not knowing that maybe around your family, some of your family members, I'm not talking about your immediate family, I'm talking about maybe your uncles, maybe your aunt, they've decided, no, they are going to have, and they are going to have policies for your mother without your consent, guys. And then when you are saying, it's only me, and then you go and also open the same thing that they are also having, and then now you're going to have issues because this person now is insured by more than 5 to 7 people, and then it's going to cost you. So it's very critical. I'll just have to check that link with the other folks there, and I will send it on the group, that you go through that link, and then when you punch your details on that link, it will tell you how many covers do you have, where have you been insured by who, so that you'll know that you're on a safe side. You can be sitting here not knowing that there is a certain person there who decided to open something on your name and you don't know about it. So the second thing concerning funeral covers is that you need to check. I'll request that all of you, as you're having funeral covers, please go and check it tomorrow. You need to check who's the underwriter. Who's the underwriter of your funeral cover? So an underwriter, like, these are the guys who are like the center. It's like these are the center of everything that is being done. Let's say, for instance, you have a funeral cover, PEP, for example, PEP funeral cover. PEP funeral cover, the underwriter is Holland. So if you have it on PEP and you have it on Holland, it's like you're having the same thing. So let's say I'm having a funeral cover with PEP and I'm also having a funeral cover with Holland, or my sister is having a funeral cover with Holland, I'm having a funeral cover with PEP. When they regulate those things, they regulate it as one thing. But we, on the other side, we count it as this, we are having something different. It's the same thing, because if the underwriter is one, it's going to be subjected on one pot. So there are what is so called institutions that share an underwriter. So you need to check who's the underwriter. For an example, the underwriter of Capitec is Capitec. Yes, Capitec Ltd, as Capitec Ltd. So the Capitec side there, even when you go to the stock market, you'll notice that there is Capitec that is selling shares based on their bank system. Then there is a Capitec, the Ltd, on the other side. So all these funeral covers, they have their underwriters. Some of you are here in the local, they say, oh, I'm for Two Mountains, some are for this. All those guys, they have underwriters, and especially small companies. Like, you talk about small companies that now are now opening, you just go there and say, no, these ones, they are cheap. You might discover that as far as they think they are cheap, the underwriter is the same with the other one that you're also having on the other side. So it will affect you because the regulation is regulated on one pot. So please check with the underwriter, who's the underwriter of your funeral cover, and you need to make sure that you are always below 100,000. You don't skip the maximum of 100,000. And I don't know why we as black people have a lot of funeral covers. No, guys, we we should cut all those things, because you should not have a lot of funeral covers, because a funeral cover is not the means to build wealth. The means to build wealth is life cover, not funeral cover. So please check with your underwriter, who's your underwriter, and make sure that if you have a lot, because so and so is paying for the same thing, so and so for the same thing, so you have to subject it to 100,000, and make sure that you guys, whether you're a family or whatever, must make sure that you stick to the maximum of 100,000. As far as I've said, the purpose of funeral cover is to cover the cost of the funeral. It was not meant to build wealth. But you know, we as black people want to steal that bit of 10,000, that bit of 20,000. And then you have noticed something about black people. Most of the black people, they don't have life covers. They have they have funeral covers, because they don't understand the importance of a life cover and how that thing works. And then even those who have the life covers, most of them will discover that their life cover is just a 300,000 life cover, it's just a 400,000 life cover. And then if you have this big opportunity, why do you limit yourself? Why don't you stretch furthermore? Why don't you have a life cover of at least 2 million, 5 million, something which is going to give you an advantage? When you speak of advantage, guys, you speak about something which is going to help you to take further steps, more than taking just a mere step here. And we have something that we call the wealth gap. Wealth gap is that all of you are in this platform. I don't know how you have started. I don't want to accuse you guys, but I have this conviction that most of you are here in this platform. In terms of how you have started financially, you have never started from something which you have inherited. Most of you have to start from your careers. You have to start somewhere, building it for your own, without taking it from your parents. And that's how, when you check the wealth gap between the white and the blacks, there is a huge gap. Beside the fact that those guys, they run the means of production, the other thing is that most of the black people, when they pass on, there is nothing to pass to the next generation. In fact, there is nothing even to pass to their children, most of them. So it becomes a problem, because if you are going to have you on this other side, you have to start from scratch. And when you start from scratch, you have this other white boy here. This white boy has already started with a lot of advantages, because they have their family businesses, they have the life covers from their parents, where they have to start from scratch. You can't compete with those people. In fact, you can't even say they are competition, because you are way beyond them. You're way beyond them. So you guys, I believe that as far as you are here, most of you have started your careers. You have life covers for your children, but you didn't inherit anything from your parents. So tonight I want to show you another strategy which you can use in terms of inheriting something from your parents, but you will be the one paying for it. But it will give an advantage to say, I'm going to use my parents to inherit something from them. Remember, the life cover which you took is for your children. It's not for you. You're not going to benefit from it. But you also, you also have another way in which you can inherit wealth from your parents without them working for it. You will be the one participating in building it, but are going to use the substance, which is the life cover. So I hope you are going to cooperate and understand this. So, but before I break it further on how we're going to do it, let me just go back again to define what is life cover, and also understand some of the things which I think they are the missing format in terms of our life covers. And because of time, there are some things I won't cover. I will finish them next week. There are some things that we won't cover. Stuff like how to make sure that your life cover is being reduced as far as you grow. I'll cover those things next week. So there are people who say we have life covers, but there is a possibility that you can also have a life cover and you discover that in your death that thing is not being paid, and you ask yourself, because this person has been paying, why it's not being paid? I'm gonna reflect to you so that you'll also revert back to your own life covers to check if there are missing stuffs there in your life covers, and then if there are missing stuffs, you'll be able to make some corrections. So I'll just take you back again to this question that most of the people they ask when it comes to life covers. Unfortunately, this screen cannot share notes, as far as I told you that the other camera which I'm using is giving me problems, so I'm using a phone. So most of the people they likely to ask which insurance company is the best. So you can't say Hollard is the best, you can't say Sanlam is the best, you can't say Asapol is the best, because your best is not my best. It's like this thing is like you wanna choose a partner. Your preferences cannot be my preferences. So in terms of defining which one is the best, we have to answer, we have to come to decide that we all have different objectives. That number one, what is the objective that you're having when you choose that that life cover? I mean to say, what are your objectives? What are your appetites and tolerance in terms of risk appetite? What is your tolerance level? And every decision you make comes with benefits and drawbacks. So there is no such thing as the best. Make a decision that best align with your desired outcomes. So before you ask a person what is the best, and that's the problem that we're having with blacks. I can maybe I can come to work and say, hey bro, I'm having this best life cover. And you say, which insurer are you using? I said, no, I'm using maybe Old Mutual. And then you just jump in. But you were supposed to ask best in which manner, because my best cannot be a best at some point. So you need to define your objectives. What is it that you're looking for when you say you want a life cover? What is it that you want to achieve? What might happen for me is I just want my kids to have a bit of 200,000 yana when I pass on, so that they will take care of that and that, and discover whether you are aiming to build wealth. So you have to define what is it that you want before you say which one will be the best. And then if you know what is it that you want, then you'll do window shopping from different insurance, and then you'll know that this one does not meet my needs or my expectations, and you skip to the one that will be able to meet your needs. So what's also critical when it comes to picking this, there are a few questions that you also need to understand. The first thing, that never subscribe to something that you don't understand. You need to understand, and I'm going to explain more based on the statement of never subscribing to something that you don't understand, because most of the people, they just want to subscribe to something but they don't understand how it operates. And the second thing is critical to ask questions. Rather be in a space where you look like a dumb, but you are okay because you're protecting yourself. You are asking right questions. And I remember, guys, when this insurance, when they take in the process of opening a life cover, they will take you through some questions, and those calls are recorded. So don't just say yes, yes, yes. You must listen careful, and if there is anything that, because most of the time they'll be using jargon. If you don't understand, just pause and say, this one I don't understand. Can you please break it down in a simple format? Don't be technical, because if, like for an example, guys who are doing IT, when they explain to you something technical, you won't understand, and discover that whatever they're saying is a simple thing, but because they're too technical, you end up not understanding exactly what they're saying. Guys in finance, they will also have their own techniques in terms of giving you whatever they are dishing to you, and you end up not understanding what is it they are saying. But if they can tell you, when we say this, we mean this, it becomes so simple. So tell them, say, no, we are not in a hurry here. Please break it down simple for me, and make sure that you understand, and make sure that you ask relevant questions before you just sign up to anything. And then the third thing, you need to get a second opinion. Get a second opinion instead of from your financial plan or financial advice. Get a second opinion, because that's the issue with us. We just want to jump and sign up for something. Get a second opinion. I was before I started the session, I was on call with someone who wanna trade in a car. So we were talking and was telling me, no, I'm under debt review. But I said, do you understand how those things work? Like the system itself. I'm not talking about just being under debt. The system itself, do you know how they've subjected it? And a person is clueless about how this system has been built. A person can explain to you, say, a debt review are going to cover all your costs and then you'll be paying us every month. But the thing is this for me, I'm not interested in what you're telling me. I'm interested on how the system has been pegged. And I also understand what is your cash there. What is it that you're going to get in that? When as the person will be reliable to settle all my jobs. What is it they're going to get? And our people, they just go for something that they don't understand. So get a second opinion and say, no, I was opting to take this. What are your thoughts? And then they'll explain to you, does but bro, this thing works like this. Did you understand when they say this is going to be like this? So you say, oh, I didn't understand this part. No, it's good. So it's good to get a second opinion. Remember, you're not an expert in this field. So don't just go there and expect. Get a second opinion, talk about these stuffs and see how you can work it out with the help of your financial planner or financial advisor. It's okay to have a day with him or just hours to sit down and talk about the whole thing. And the last thing, you need to read up on it. But whatever you do, but whatever, don't just accept information you don't understand. So a good financial advisor will take time to explain and educate you, and a good client will take time to understand. The issue with sales reps, man, they are even given a title. If you go to these insurance companies, sales reps are given a title of being called financial advisors. They're not financial advisors, they are sales reps. But in their standard of whatever they call it, they are being titled as they are financial advisors. But in a sense of describing them, those guys, they are sales reps. So they're aiming to close in a sale. And whatever it takes, they'll do it. And I was listening to one of my friends was telling me that, I've been working in a bank for a very long time. They've trained us this thing. They've trained us to say, make sure that the person pick up whatever you're selling to him or her will cover everything for you. So whatever it takes, just make sure you push the person up until the person settles for whatever you're presenting. So make sure, guys, that you read up everything and make sure that you get a second opinion. That's very critical. So we have, sorry guys, because I don't have the screen here. We have 3 main types of life insurance. As I've said to you, you can have a life insurance, but at the end of the day, discover that they don't pay you out, because these stuffs, they are regulated differently. So we have 3 main types of life insurances. So I don't know which one did you took, and I'm going to explain to you, and then later on I'm going to explain how we can use this life insurance to build wealth. So the first type of an insurance, we have what you called accidental death cover. We have accidental death cover. So let me explain how this one works. Accidental death cover. So this type of cover only pays if you die due to an accident like a car crash, a freak accident, or a result of violent crime. So in terms of violent crime, as long as that crime is not committed by you, you will be paid. But if you are the one who was committing the crime, they cannot pay you. So accidental death cover, it only covers you if you happen to be in a car crash or any accident, or there was a crime scene and then you were shot there as a victim, then they're going to pay for that. So with this type of a cover, if you die from illness like cancer, heart attack, whatever illness it might be, if you die from illness, this cover cannot pay you, because it only pays you if you are involved in an accident. So this one can be good for guys who are working with maybe like in risky spaces, where these guys are in risky spaces. Some of the employers, they do have this. Beside when opening it for yourself, some of the employers, they do have this. That's why you have to read your contract when they hire you. People, they rush to go to church and give testimony without reading their contracts. So you might discover that your employer does offer this to say, okay, well, now you will have this option. If you happen to die at work, maybe Let's say you're a police officer. If they shoot you, you will have an accidental death cover for you, beside the cover which we're now going to open for yourself. So if you happen, maybe they shot you at work, and we are going to cover, we have covered you with this 5 million or with this kind of amount. So you know, and then you must share this with your children, because remember, when you're gone, no one is going to explain it on your behalf. You must say it with your children. If you have a will, you must write it on your will. What's going to happen there? So maybe you are what's so called, maybe you are working with anything that involves a danger, you understand, that can cause an incident. So maybe you're driving somewhere, they'll say no to you, man, we are having accidental death for you. So if something happens to you, this is the cover that's going to cover for you. So your children are going to inherit that. So you must be also a good communicator in terms of where your staffs, with your children. If you have a lawyer, go and communicate with your lawyer, so they'll set it up for you, and then know what, if something happens, we have this cover. If they refuse to pay, you know from your contract, it was written from your contract that we also cover you for stuffs like an accident that can occur while you're still at work. So it is also their responsibility. So the second one, after the accidental death cover, as I've said, the accidental cover can only cover you if you're involved in an accident. But if you die by illness, they're not going to pay you. So hence I say to you, never sign up to something that you don't understand. Make sure that you sign up to something that you understand. So the second one is called fully underwritten life cover with medicals. Fully underwritten life cover with medicals. This is the second one, second option. Fully underwritten life cover with medicals. So this one is the most solid and most recommended by financial planners and financial advisors. So this one is the one that most of the financial planners, when you visit them in terms of setting up your finances, they will recommend that you have a fully underwritten life cover with medicals. So in this life cover, what is it that they're going to do? They will take you in the process of blood test and answer detailed questions concerning your health. So and maybe even to further it, you have to go and see a doctor. So whatever they're going to find, remember, whatever they're going to find is going to determine your monthly contribution. So let's say they say, no, when we're assessing, you have discovered that you have a heart attack. They won't say because you have a heart attack, won't give you the life cover. They are going to give you a life cover, but your life cover will be expensive because they will underline you as a person who's a high risk. Or maybe they take you and say, okay, because of 1, 2, 3 issues, we are going to increase your life. It was supposed to be in the standard, but because you have maybe high blood or whatever it might be, you are going to increase your life cover. So these guys, they are aware, since they're going to take you to medical. So that's why it's called fully underwritten life cover with medicals. And most of us, we don't want to go to medicals, we just want a life cover. So this one, the reason why most of the advisors, they recommend it is because whatever you might be having, the insurer knows it. And because the insurer knows it, after passing on, they'll definitely pay you, because they know that you had this situation. So because of this situation, it's easier for us to pay. But if they don't know, they won't be able to pay you. They might deny and say, okay, this person died with heart attack, but when we're asking the same person these questions, the person said it's healthy. So this one brings staffs to transparency, that they know that if you have issues, okay, these are the health issues which you are facing, and then because of these health issues which you are facing, then you're going to be built under people who are high risk. So that's why it's very much important for you to have what is called a life cover while you are still young, because at the young age, your life cover is cheap. There are things which also determine how much you're going to contribute in a life cover. Things like age. So your age is one of the primary factors influencing your life insurance premium rate. So typically premium amount increases on average of 8% to 10% every year, of age. It can as low as 5% annually if you're in your 40s, and then as highly as 12% if you're in your 50s. So if you're in your 50s, it can goes to 12%. If you're still below, your 40s, is 5%. So it's better to do it early. It's better to do it early, because the early as possible as you can do it is the less you're going to pay. So that's why if you can wake up and say you want to open a life cover for a person who's in his 60s, 60 something, it's going to be expensive. But if you're still young, it's going to cause your monthly contribution to be less. Some of the things which they also check your occupation. So occupation is expensive when you're working a high risk job. There are some jobs which they consider them as high risk jobs. So guys like firefighters, they're high risk jobs. Those guys, they're on high risk. Guys who like crime unit, those guys, they're high risk. So any job which is a high risk, you are also going to pay more because of your occupation. So guys like teachers, you can't die with a chalk, man. Teachers, they are safe because their working environment is safe. So, but guys who are working there, maybe as soldiers, as police officers, those guys are considered as high risk. And the other thing is also the issue of gender. So life insurance is cheaper for women than men. The reason why it's cheaper for women than men is that, according to stats, men, they die early. And it's because of their habits. Men, they die early, but women, they certain stuff they're going to test you, and if they discover that you are smoking, they count points, because that thing is programmed based on points. So if you are smoking, if you say you are smoking automatically, I think they were minusing 5 to 10%, and then it's affecting you. So you better not smoke. If you're smoking, you must find an alternative to quit smoking. Or it will affect your life cover. So as I was saying, that the second type of life insurance is fully underwritten life cover with medicals. So this one is subject to medical. So the last one is called underwritten life cover with no medicals. Underwritten life cover with no medical. So this one is I'm sure that most of you have this one, where no medical test but short questionnaire. You're going to use a phone, and they ask you questions, and then you answer those questions, and yeah, that's how you wrap up that life cover. So the problem with this one is, if you forget to mention a health issue, or even leave out something by mistake, they can refuse the payout at claim stage. So if you happen to forget that, no, I have hypertension, and then discover that later on you die with hypertension, they might refuse to pay you out. So this one, you must make sure that if you don't want to go for medicals, whatever questions that they're going to answer you, you have to answer honestly. But the issue is this: I'm not a doctor. I might assume that I don't have this, but while I'm having it, so better to go for medicals, because whatever I don't know about my health, the doctor will evaluate, and if they find something, so okay, this person is having 1, 2, 3, 4, and 5, and then that's a determining factor. So the determining factor is that it's going to influence, obviously, the rate of my insurance. But it's safe, because at the end of the day, I want a payout. So the underwritten life cover with no medicals. The tricky part is that if you forget to mention something, or if in those questions which are going to answer you skip some of the answers, so you don't answer them correctly. Remember, when a person pass on, there's a report which is going to be written from them post-mortem. They're going to write a post-mortem, then you have to submit that. Then they're going to read, this person died with this kind of sickness, and you have never told them, and they say they're going to deny you that claim. So meaning you have paid all these years, you have paid all these years for nothing. You have paid all these years for nothing. So guys, make sure. For me, I'm not saying I'm not saying go and do it, but for me, I prefer that you have the underwritten life cover with medicals, because that one simplifies the work. Whatever they're going to assess and get in your body is going to be covered there. So you know that if something happens, even if the postmortem come and say you died by this, they already knew, because the medicals has revealed that you have this underlying issue. So but if you go for this one where there are no what's it called, there are no medicals, and then it happen that they find out something, it can affect your policy. So hence I've said to you from the beginning that there is a possibility that one can have a life cover that at the end of the day they fail to receive their investment because of some factors. So make sure that when you go for a life cover, go for a life cover with an underwritten life cover with medicals, rather than to go for something without medicals. So I hope you understand me on this point. These three main types of life cover. So in terms of, there are terms in when you pick an insurance, there are terms. So we have what is so called a term life insurance. So a term life insurance, the term life insurance cover you for a fixed period. You must have an agreement. My mother once had a term life insurance, and I believe it was because they've never explained to her what is a term life insurance. They just said, here it is, and then it was a loss for us. So a term life insurance works like this. So term life insurance has the limit of 10, 20 to 30 years. So it will depend on you. You wanna take it for 10 years, you wanna take it for 20 years, you wanna take it for 30 years. It will be up to you. So let's say you took it for 10 years. This thing is it can only pace out if you die during that term. So let's say, for instance, you took that one of 10 years, and then you don't die in that period, and then 10 years passed, pooh, you don't die, you have lost. So you must make sure that you die. You must die. Because it's either you look at the investment and say, I've been contributing this kind of money, I'm not dying, already on 10 years. So if you don't die, it will be a loss. You have to die before that period. So it can be 20 years, it can be start from 10 years to 10, 20, 30. So but if you don't die between that period, you won't receive anything. So the term life insurance is cheaper. The thing is that this thing is cheaper. So it's cheaper than the whole life insurance, and it's easier to understand. So you can use it to cover your children until they reach a certain age or independent age. It's up to you if you want to use this. So most of the people, they use this, they say, if I happen to die before my children reach 18, this one will be able to cover for their studies and other costs. That's why they pick it up. So if it happens that your children, if it happens that you leave and your children be able to go to secondary level and go to varsity, don't die, it means after it will elapse, and then all the contribution will be lost. So that's one of the reasons that people are using this, and it was one of the reasons why my mother picked it, because she said if she passed on while we're still studying, we're going to have a problem. So she said no, she have to take it, so that if something happens to her, we'll continue to further our studies and take care of some necessities using that cover. But unfortunately, she didn't die, and we didn't want her to die. So the money is lost. All of it is lost. So it was a risk side that if she dies, we will continue with our studies and we'll be able to live a life comfortable, because the insurance will be continuing to pay to take care of the necessities that she used to take care of. So, but we managed to, even now she's still alive. So it's a loss. So it's up to you guys. As I've said, it depends on also what's your plan, what's your objection, what is it that you want to achieve at the end of the day. So the second term, we have what is so called the whole life insurance. So the whole life insurance insurance is a permanent life insurance with long coverage. So it offers a fixed death benefit, and most of the whole life insurance policies pay out dividends. So most of them, they have dividends. I don't know if you know that your life cover does have a dividends. Some they don't have. So the payouts on the dividends can be used to reduce the premium payments or can add to your cash value. It's up to you whether you wanna take that money to reduce your monthly premium or you wanna withdraw the cash itself. So the whole life insurance is more expensive compared to the term insurance. So life cover is much cheaper when you're healthy. It's much cheaper when you don't smoke and engage in high risk activities and work in less risk profession. So if you're going to go for a whole life insurance, it might happen that when you consider it, you compare it with the term life insurance, the term life insurance is cheaper compared to the whole life insurance. But this one is good because it's a guaranteed thing. It covers you whether you pass that age of 78, you are still covered. But with the term life insurance, it can't go with you there. So I'd rather go for a whole life insurance and making sure that it's an underwritten one with medicals so that I know I am protected. So there is something in the insurance which I don't know that most of you, I'm sure you don't know about this thing. There is something this thing is called immediate expense benefit. I don't know if you know it, you can raise your hand there. I'll see the one who's raising a hand. It is called immediate expense benefit, and I've discovered that most of the people who are having life covers, they don't know this. Hence, you discover that you have a life cover on this side, you also have a funeral cover on this side, but you can use what we call immediate expense benefit, and you don't take what is so called a funeral cover in terms, because most of the time you have a funeral cover that pays you a certain amount. Maybe this funeral cover says when you pass on, you're going to pay 30,000 or 40,000 or 50,000. But you can use this thing; it goes together with your life cover. You have to ask your insurer if your life cover have immediate expense benefit, because it simplifies things for you. Let's say, for instance, you're contributing this certain amount for your life cover. At the other hand, you also need to contribute 300 for your funeral cover. But we're not supposed to be like that, because you were supposed to say, I'm going to take an immediate expense benefit from my life cover. So if you have a life insurance and you don't have an immediate expense benefit, you can call your insurer tomorrow and ask them about the immediate. Does your life cover have what you call immediate expense benefit? So how does it work? So it goes like this: if you pass away, your beneficiaries will be paid 10% up to a maximum of 50%, depending on the company. Each company has their own value. This amount will be paid to your beneficiary within 48 hours of your passing to utilize the immediate expenses. So the immediate expense benefit, it works like this. So if you pass on, let's say your life cover is 2 million. If you pass on and your life cover, it has an immediate expense benefit. The immediate expense benefit is aside. It's not counted on the 2 million which you are having. This is the amount which they are going to pay your beneficiaries to take care of the immediate expenses. Man, they wanna buy food and this and that. They're going to pay them from the immediate expense benefit. It's not from the 2 million. I hope you are getting it. The 2 million will remain as 2 million. But since you also took immediate expense benefit, they're going to give them a certain amount to pay for the necessities that they are going to have to run the funeral. So this amount it depends on the insurers, from 10% up until to 50,000. Some they can get 30, 40, 50. As I've said, it depends on the insurer which you are using. So they'll make sure that they pay them this amount within 48 hours so that they'll be able to take care of the immediate expenses. So the amount will be deducted from your lump sum life cover, and this will be paid to your beneficiaries, which they can use it for funeral and burial costs. So check with your provider to see if they have this. So you see, let's say for your funeral cover you're paying 300 every month. With immediate expense, you can be paying something like 100 rand. I nearly say 100,000. You can pay 100 rand, 74 rand, 105 rand, depends. So but you cannot pay more than 200 or 300. You'll be paying less. So you'll be saving that bit of 100 rand that you are paying more on your funeral cover, because the immediate expense benefit is less, it's cheaper. It's cheaper. If you go to financial planners, they will tell you about the immediate expense benefit. So it's cheaper compared to those 300s which we are paying for our funeral covers, and maybe we pay even more than that, or the 400s we pay more than. So the immediate expense benefit, it goes together with your life cover, which is going to help you to reduce your monthly expenses, and also give you a room to say, but it's okay if it goes together with my life cover. I don't need to worry about the funeral cover in terms of cash. So I hope I hope you get it. So you can ask your, what's it called? You can ask your insurer about your immediate expense benefit. You can call them tomorrow. If they say have it, they'll tell you how much it will cost every month. You can opt for it, so that money will be paid to your beneficiaries in terms of you passing out. So now coming back, how then do we use the life cover to build wealth? How do you use it to build wealth? I remember, I understand that we'll say no, our children will be able to inherit the 2 million, the 5 million, 10 million. But for us, how do we use it? Remember, when I started, I explained to you that we are supposed to receive something from our parents, but most of us, we didn't receive it. You have to start from scratch. But there is a loophole that we can use to benefit from our parents. And then I want to give you that perspective that we can use it, and it's possible to use this format. So okay, because there are two divisions here. There is a division where it's you who's building the life cover for your children. There is a division which I want you to use it on the other side to benefit something from your parents. I just want to check up with you, guys, how many of you here in this platform who have kids who are from 13 going upwards? How many? You can raise your hand, I can see, from 13 going upwards, because I'm sitting here with you guys. We're talking about these stuffs, but I'm also concerned about the kids, because these are the guys who are going to take over your stuffs. They're going to take over whatever you're building. So, okay, I see one hand there. I see, okay. Okay, so because I just have to, okay, that's also so one, okay. I see. Because you have also to create a platform for the young people, to talk with the young people, to prepare them to take over. So yeah, but I'm going to see how we arrange that. So how then do you benefit from your parents building wealth for your own self, as building a capital, as far as you started from the scratch? We have something is called insurable interest. It's called insurable interest. Sorry. So insurable interest, if your parents are below 65, but I know there are other companies who can go above 65. They can even go to 70. So it's all about you doing the window shopping. So, but usually most of them, their maximum is 65. So if your parents are below 65, you can use what you called a insurable interest. So what is insurable interest? Insurable interest, it refers to the legal and financial relationship between the policyholder and the insured. So to have an insurable interest, the policyholder must stand to suffer a financial loss or detriment upon the death of the insured. So the principle ensures that insurance is not merely a speculative venture, but a means of providing financial security against a genuine risks. So these things work. This thing work like this. Like, let me just break down in simple format. Insurable interest. Let's say I'm having my mother, so I wanna use this format of using the insurable interest. what I need to do, I need to write. I need to have a valid reason. I need to have a valid reason to take this package. A valid reason, like if my mother passed away, it's going to affect my income. Or if my mother passed away, she was the source of the income in the family. So if she passed away, it means we won't have an income. Or she was the one who was responsible to take care of my children, or I'm the only person who's working here at home. So you must have a reason why you are putting this person. So the person will be, will be the policy holder when you'll be a beneficiary. So let's say my mom is below 65, then I have the insurable interest. I speak with the insurer. We have an agreement that okay, my mother, she's the one who's providing the income here at home. So if she passed on, it means we won't have an income. Or I am the only one who's working. If my mother passed away also, it means my siblings will be under my care. So because of that, I will need this insurance. So as long as you can prove it, then these guys, they can give a go ahead. Their maximum is 2 million on this one. So you can have the 2 million a life cover using a parent. It can be a father, it can be a mother who's below 65. But as I've said, these guys, that we have those ones who are able to provide more than 65. Even people who are at 70, even people who are at 75, they can still cover them. So they will check they'll check this individual to medicals to check the person, and then they will determine how much you need to contribute every month. So this can be a good advantage for you. Remember, you didn't receive anything from them. So, but now you wanna use them as an advantage to say, okay, my mom is 65, or my dad is 65. I'm going to project her on this so that when she pass on, I'm going to get the 2 million. So that 2 million, I believe a 2 million can be a good start for you. Remember, for your kids, you do have it. For your kids, if when something happens to your kids, are going to inherit that life cover. But if your parents pass on, you're inheriting nothing. So don't let this opportunity just pass. Make sure that you use the insurable interest. So there are there are a lot of insurers who offer this. Sanlam are one of the guys who offer it, having the best. Old Mutual, there are different insurers who offer this. You just need to have a reason why insuring this person. So you must give them a reason. Maybe this person is the one who was taking care of your children, paying for their schools and everything. Whatever reason might be, as long as the passing of this person will affect your income, you do have a chance to inquire, to insure, to use this person, and then be able to benefit from this person. And it's something that no, we have never thought of it, because we were told that no, if a person is of this age, you can't be able to open a life cover for him or her, but you can use the insurable interest. You just have to have a reason why are you putting this person. So that the reason, obviously, it must go to the financial security, that if this person pass on, maybe I'm the only one who will have to take care of my siblings. My siblings still have to go to school, or this one was responsible to take care, whatever reason might be. As long as it puts your finances in risk, you have that chance. So this can be an advantage for you now to have what you have wealth. As I've said to you, you have done it for your children. If you pass on, your children are going to inherit something. So do it for yourself. And then that capital, man, it can be a good capital for you to start up your life rightly. Maybe you'll use that 2 million, whatever you are going to use it, but it's going to be for your good benefit. So make sure that you take that advantage. This thing of us only having our parents in funeral covers, it must stop, guys. You must also use it as an advantage. You must also use them as our advantage to build wealth also, because we are supposed to inherit the life covers from them. But you discover that our parents, those days, life covers, I thought it was a taboo to them. They have never taken advantage. They only had, what I know is that every parent does have a funeral cover, but most of them, they don't have a life cover. So you can use the insurable interest to make sure that you open a life cover for them, and then you know that in their 60s you won't be paying for many years, because people are dying now. You won't be paying for many years. So it will be a good advantage for you, because you'll have a capital, and that capital is going to help you a lot, because you won't be taking from your children. It will be you who's in getting something from your parents. So the context, there's a context that there's, okay, who fits in, who does not fit in this. So number one, your family relationships. So family relationships, you can use these insurable interest to cover immediate family members such as spouse, children. Yeah, these ones you can cover them. So that you can use your children, your spouse, you can cover them. And then also, but this one is so, I feel like this one is so dangerous. You can also use it in business relationships. So let's say me and you are business partners, but this one, people are going to kill each other. Let's say we are business partners. So in business context, partners often to have insurable interest in each other's lives. So this is particular true in partnership where the death of one partner could significantly impact the financial viability of the business. So let's say we are business partners, and then I have this insurable interest with you that if you pass on, it's going to affect me because I won't be able to manage all the financial needs of the company. So I have it for you, you also have it for me. So black people, and it's okay, but you have to find a way to disclose it also to your own spouse, and then have a bit of a lawyer to cover it, to say what will happen, because if I say I'm taking it on your behalf, or but in business it's simple, because in business you can take it under the name of business, that if this person dies, and this is something that employers can use. If this person dies, then this one is going to rate it through the business, or the person's spouse is going to inherit this amount, then the business will be responsible to pay for this. Or it can come direct to the business, and then the business will be the one paying it to the family, or paying it to that individual's wife, whatever it might be the case. Whatever is going to work is going to rotate just like that. So it's a good thing, and I believe most of the businesses, they don't know this, and it can work for especially business partners. It can work advantage for them, because as far as people are running business as business partners, if something happens to them, we need to make sure that as business partners that are left, we make sure that we take care of their children, we make sure that we give them a dignified funeral according to our standards. But if we have this interest, insurable interest, it can be simple, because their children can inherit this 2 million and say, here's the inheritance beside the other inheritance from the business, but they can also have the advantage of this 2 million. So I'm sure this one you are aware of it. The other one, the creditor debt relationship. So usually lenders, they have insurable interest in their lives of their borrowers. So they know that if you take this and you happen to die, so the insurance, that's why most of the time installment was not supposed to be the amount which you are paying, but because of the insurance that is included. The insurance that is included there is called insurable interest. So they know that if something can happen to you before you reach that agreement, or the period which they say you're going to pay for, if something happens to you, they're going to use this insurance to cover everything. So that's why I don't know if you have ever seen the educational investment of Old Mutual. What makes it to be less effective is because it comes with an insurance in it. So the insurance takes a lot from the initial investment. Hence, the amount is not making sense at the end of the day. So creditors, as far as I say, they use it. They know that if something happens, they are going to be covered. So it's up to you which context can work for you. Are you going to use it for your parents, your children? But for me, I will say let's use it to our parents. As far as I've said, we have never inherited. Okay, maybe let me just rephrase my statement. Most of us we have never inherited from our parents, so we can now use this in insurable interest to say, let me just use it for my parents, that if they happen to pass on, which is possible, because as long as we are still here, we are still waiting for Jesus, people will continue to die. So if he or she pass on, at least I'm going to have a capital of 2 million from their lives. So I'll be responsible, because it will be simple. You will be the beneficiary who is responsible to pay for this insurance. Then your parents, your mother or your father will be the police holder, which simplifies everything for you. I hope you get it. So this is the way which you can empower yourself. Remember, I said your children, they are going to empower themselves through your own life cover. Because if you have a life cover of a 10 million and a child has to start from that thing, it's a good capital. So don't have just a funeral cover, you must have the life cover to empower them. Beside the other investments which you have done, they also have a life cover. So it gives you an advantage. The reason why black people they do less in life is because they don't know how to use such instruments to build wealth. So let's go out there and do our assignments and make sure that we take this advantage and let this advantage work for our good. So I don't know if there's a person with a question, you can open your mic and ask a question, then I'll be able to answer our question.